Welcome back. Stocks are higher this morning. Take a look at futures indicating a gain at the start of trading. The Dow Industrials are up 46, the Nasdaq up 23, the S&P higher by 6, the Dow closing more than 100 points higher yesterday as stocks look to recover some of those losses from that big sell-off on Tuesday. Take a look at yesterday, where the Dow was up 151 and the Nasdaq was up 203 points yesterday. Nice rally, which is getting extended this morning, even as interest rates stay elevated, but they're pulling back today. We're now looking at the 10-year down almost 2 basis points this morning, sitting at a level of 4.23%. But of course, remember, before that 60 Minutes interview, when Jay Powell said we're likely not seeing too many cuts this year, actually the yield was below 4%. So we've had a good rally in interest rates since then. Federal Reserve Vice Chairman for Supervision, Michael Barr, says the central bank needs to see more positive data, good data on inflation, and that he does support Chairman Jay Powell's careful approach to rate cuts. Joining me right now is Portfolio Wealth Advisors President and Chief Investment Officer Lee Munson. Lee, great to see you. Thanks so much for being here. It feels like investors are just taking their cue from the latest sentiment out of the Fed. They're going to cut, they're not going to cut, and now we see a lessening expectation of rate cuts coming sooner, and that's why stocks have been under some selling pressure. Your thoughts?
I've been talking about this for months. We're going to see hot CPI prints and you're going to have these reactions. I was saying this in November, December last month. Here's what's different, and I think here's what a little bit of sunshine on the market is. Investors now have come to realize versus 6 weeks ago that the cuts aren't going to happen in March. The majority of investors now are with the Fed. This is no different than investors getting ahead of earnings. You know, we can't price in 2025 earnings in February 24, and we can't start pricing in, Fed cuts that aren't going to happen until later this year. Here's what I think people miss. And here's what I think some investors, as we see this market float up, are looking past. The hot print, the 3-point-something versus 2-point-something on Tuesday. Remember, that's the big psychological barrier, is always seeing a 2 in front of that print. Most of that was driven by shelter that came in at 6%. Now, if you do some actual homework and you get in the numbers and you look at things at Zillow or apartments.com and you look at more up-to-date data on the inflation shelter, it's much lower. So I think as we get further into the year, I think a lot of investors feel it. I think a lot of investors know that the Fed is going to overshoot. They're going to keep rates tighter than we would like, tighter than they need to. But investors know that now. And that shift in sentiment, that shift in change, the reality setting in, I think is more of a positive. And I think that's why we're seeing a rebound, because people know by the time we get closer to the end of the year, that shelter number is going to come way down. It's going to come fast. The other thing is we got the Fed put is back, and that's got to give some confidence to the market.
Yeah, I want to ask you about Cisco. Mark Tepper, jump in here, because Cisco is a highlight today. It is a issue. It announced it's going to cut jobs, more than 4,000 jobs being cut at Cisco from the global workforce, despite reporting a double beat in the fourth quarter earnings yesterday. It issued a light full year guidance, though. Mark, I think that's the issue here. The stock right now is down almost 5%. Morgan Stanley reporting it's going to lay off hundreds from its wealth management unit as well, by the way. We've got a big day of earnings on deck. We're waiting on Deere reporting a double beat, cutting its 2024 profit forecast. And we'll hear from Wendy's and Penn Entertainment later this morning, followed by Roku and DraftKings after the bell. Mark, weigh in here on earnings and what you're hearing from Cisco.
Earnings growth this quarter has been surprisingly stronger than expected, but a lot of that is due to what they're calling operational efficiency. So that's the new buzzword that's popping up in transcripts right now, which is code for layoffs. So in order for companies to exceed the bar that's set for their earnings, they're having to cut more people. We're seeing a lot of this happening specifically in middle management positions. So that's concerning. So my question for Lee is, Lee, if that is the way that companies are hitting their earnings metrics right now by cutting staff, how long can that persist before all of a sudden it's like, okay, we've run out of people to cut. Now we really have to sell more products and more services?
I think it's a game of chicken between now and how much we cut rates and how slow this economy gets and how much the Fed overshoots. We were talking here, I think it was about a month ago, the three of us were talking about bank earnings, and the first thing I said was they set the tone and pace for the year. And what did all three of the major banks, all four, they all said one thing: we're going to cut. Now, I've seen this over and over again in cycles. It reminds me very much of 2002, 2003, where we were in a severe bear market, the Fed was tightening, and companies like to cut. Now, the thing that we have to remember, it takes about 2 quarters for all of those layoffs to really show up in the earnings. And I think that's what a lot of CEOs are thinking now. If we can cut now and we can get a little bit of tailwind over the next couple quarters, then maybe the economy doesn't slow down as much and everybody can hit their numbers before the end of the year. But we're at the desperate tag-ins of corporations trying to show growth in this year.
Yeah. Well, look, Lee, we'll see what the numbers come out today have to say about growth. Got retail sales coming out, PPI tomorrow, and of course, the next Fed meeting in March. Great to have you this morning, Lee. Thank you.
Thank you.
Lee Munson joining us. Quick break and then a day.